we're going to go high tech. A couple of things we're going to review about Chapter 1 that we've already gone over Chapter 1. But one of the things is that to be a resident alien, you either can get a green card. If you get a green card and you want to be a resident for the whole year, you can be a resident for the whole year. If you choose to be a resident for part of the year and non-resident for part of the year, let's just say you move here in the middle and you made a bunch of money in some other country you don't want to be, so you would be a part-year resident. And you'd file as a part-year resident. You couldn't use the standard deduction. But you started as a resident in the middle of the year, and you might only be till the end of the year for that tax return. If you weren't in the United States before that, no problem. If you were in the United States as a non-resident and you wanted to not consider yourself a resident because you didn't want to pay tax on it. So, and you don't want to pay tax on your income that you earned in another country, you would be a non-resident until you became a resident. That would only really happen with the year you come to the United States and the year you leave. And we're not going to get much of that, and they're not going to really have a lot of questions on that. What I want to do is okay, so residents. Okay, real quick, I'm going to go over substantial presence test. So you have two ways to be a resident, right? One, the green card. You come in, you get a green card for whatever way you get one. Okay, then you can be you're a resident. You don't have to have been here all year long. But if you want to be a resident for all year long, you've got to pay tax on your worldwide income. So I had a guy that just came in recently. He's been holding off until he got the Social Security number for his wife and his wife's child. They're from a different country. He has a good salary. He's an engineer. You have to have your Social Security card by April 15th, or you have to get an extension and you get 6 more months. They didn't get their Social Security cards by April 15th, so they filed an extension and we could file them. He can now file married filing joint, and he has a son for a dependent. Because why? Even though the wife wasn't here in the United States, the wife and the son lived together all year long. It's her son under the age of 19, and he didn't support himself, wasn't married. So they get to claim it because they're married, right? But he couldn't have done that unless they'd gotten their Social Security cards, Social Security numbers. Okay? So here's substantial presence test. So to be considered, or let's just say for the year 2018, to be a resident in the United States, you don't get to choose this. I have a friend from New Zealand that used to have to do this every year, count his days. He worked for the International Monetary Fund. He was married to my wife's best friend, actually. He was married to a local girl that grew up here, but he did not want to pay U.S. taxes. He earned his money around the world. He was an economist, and he goes around the world for the International Monetary Fund, and he would go to a country and add up all their cows and chickens and wheat, all wells and all the different stuff, and go back and report, well, is this a good country we should loan money to? They want to improve their country. He would also try to find out if the guys from the country were a bunch of crooks. And lo and behold, they were. Okay, that's beside the thing. So he had to every year be out of the United States a certain number of days so he or because he did not want to qualify as a resident. Okay? So the first rule is if you're not here for 31 days during the year, you don't qualify as a resident under substantial presence test. Okay? The other rule, if you're here for at least 31 days this year, you'll count 183. If either this year you're here for 183 days, you're considered a resident. What does that mean? You got to pay taxes on all your worldwide income. And if you're making a bunch of money going around the world, but you're never hanging out in Hawaii, you don't really want to do that if you can get out of it. So, the 180 days, the way you calculate it, and this has been a question every year. 1 out of 4 or 5 of you will get that question. You take 100% of the days for this year. So let's say that the guy was here exactly 120 days. So you'd add 120. And then in 17, you were here 120 days. You'd take 1/3 of those. 1/3 of 120 is 40. Then in 16, he was here exactly 120 days. 1/6 of 120 days is 20. So he was here 180 days. This guy, first he was a math major in college, and then an economist after that. He had to sit and do this every year, but he was meticulous. One year he had to leave here on Christmas Eve. He did. Got on a plane and left. Okay, so in this, it's below 183 days. But let's say that you were here 123 days. Well, just this one day, 123 now makes it 183. So they would now have to count your entire income. Where this guy's from that I'm using as an example is from New Zealand. New Zealand has a rule that if you earn money in other countries, New Zealand doesn't tax you. So if he followed this rule, he made, as an economist for the International Monetary Fund, a good salary. Let's say over 100 grand easy. New Zealand didn't tax him. If he stayed out of America, and even though his wife had to file married filing separately, but she didn't tax him, or the United States didn't tax him. He paid 0 tax in the world. But he also had to go and spend lots of time in a lot of third world countries. Lots of different places in Africa and, well, Fiji and several other even smaller places. He did spend some time in Samoa, but he can't go back because he told the International Monetary Fund that the guys running Samoa at the time were crooks. And the guys were going, we're going to kill you if you ever come back here.
Oh, God.
Hello. Okay. Did you get a book or anything?
It shipped this morning. Is that okay?
Yeah. Did it ship through me or, because I've got a bunch of shipping to you.
To me.
Okay. Okay, everybody got that? Mm-hmm. Now, that's going to be, and then what they're going to do is give you a variation of what I did. So many days one year, so many days the next year, and they probably won't make it all 120 exactly. I do that because I know how to make it work out just the way I want it to. Yes?
If they make, if it's 25 days instead of the 31,
Doesn't matter. If they're only here 25 days this year, well, then they're not really a resident. You're not. It would be really hard to get to 183 days. So 1/3 of 360 is 120.
Right.
And 1/6 of 360 is 60. That's 180. You're still short. I guess if you were 25 days, you could just barely make it. But you'd have to be the 31. That's the first rule. 31 days minimum. And that will probably be a test question. Okay. None of you guys have taken any of the tests. If you took part 1 last year, did you have anything before? We've never had anything about, it's called the FBAR, Form FinCEN, Form 114. Last year, for the first year, they did. So I'm going to go over this year. It's a little bit in the book, but it's not something you see on a tax return. In fact, this is not part of filing income taxes, and I'm not sure why they're making us do it, but they brought that out last year, and 2 or 3 people told me, you know, what is that? Okay, so there's a rule that says you have to file a special form. You have to do it online. You can't send it in. And it's called, you go on irs.gov and go FinCEN or KBAR, FBAR, and then a form will come up. And what it's asking is, do you have more than $10,000 in bank account in a foreign country? So if let's say that your savings account in some foreign country, you're familiar with it?
Yes.
You have to do it for some of your customers. If you got more than $10,000, you're supposed to fill this out.
10,000 in any given time, so you don't really try.
Okay. So, let's just say I had $12,000 that my mom gave me. And whatever, I come from Thailand or the Philippines. This happens a lot in different countries. Then you're supposed to fill this out. You're supposed to fill it out by April 15th. You get an automatic 6-month extension. Okay? It's on page 8 or 9. CINFIN, if you want to know about the FBAR CINFIN, it's on page 9. Besides that, they usually only ask one question. When's the due date? April 15th. The extension is automatic 6 months later. What is the amount? $10,000. There's another form.
I wonder how successful they are now, because that's been like, they've been mentioning that for us too.
The
For
reason
so long.
they're trying to do this is they're trying to get everybody to start doing it. Here's what they're trying to catch. A lot of people that are putting their money in foreign bank accounts. So what is the fine? I believe even for that, if you don't file those forms, they can go up to $10,000. What?
$12,459 per violation.
Wow.
But what happens, I filled out one before, what do it's just a reporting, right?
Yeah, all you do is put down the name of the bank, their location,
Address.
their account number, the amount that you had in there. And if you have 3 banks, you put all 3 of them in. And then your name, address, social security number, that kind of stuff. It's all done online and it's really easy. I used to do it for free for everybody, but I don't have but 1 or 2 a year. Not many people come. Okay, here's the second one. Individuals must use Form 8938. That actually goes on the tax return. Hardly anybody I know even knows about it. Okay, the reporting requirements are assets with an aggregate value of more than $50,000 on the last day of the year, or $75,000 at any time during the year. Then you're supposed to add this to your tax return. So we could be liable if we don't ask them, do you have any foreign bank accounts? Where are we supposed to have been putting that all along? Schedule B, at the very bottom of Schedule B, there's a couple little questions in there. Do you ever forget to ask your clients that? Yeah, all the time. And I shouldn't, I know. Every now and then I've asked, and I think to remember to ask. But I don't generally. That's not my client base though either. Okay, so what is the form? 8938. You need to know that number and to know the 50 or 75. If you're married filing joint, it's double that amount. Last year was the first year that they had those two questions on there. But they had them. On the next page, there's a form that I've never even heard of. It's called 5471. If you are officers, directors, shareholders of certain foreign corporations, I don't think they're gonna play gotcha like that. Okay, so a few other things that we went over. So, innocent spouse relief, just generally, I can't really tell you anything more than you just reading it. But that's something they sometimes have. Kiddie Tax, the bad news is Kiddie Tax has changed. What did they do? Now for Kiddie Tax, you're gonna have to pay the same tax rate as trust. Something like 30%. Have a seat. Okay, Kiddie Tax, you get a standard deduction of either 1,050, yeah, 1,050, and then you get up to the first 1,050, you pay regular tax on. So that's $2,100. That might be your question. How much of it before you have to start paying Kiddie Tax? And it's unearned income. Interest, dividends, capital gains. On the other hand, if you have a little 18-year-old, 17-year-old, and they make $5,000, $10,000 as just income at a job, they work at McDonald's or somewhere, that's not unearned income, and that doesn't apply. So the standard deduction is $12,000 or $375 for unearned income plus the difference up to $12,000. Does everybody pretty much remember all this? Does this sound familiar? This is reviewing chapter 1. You've already got your books, right? Okay. So, virtual currency on page 42, if you have the books. If nobody has the books really yet. Okay, there's going to be very little on virtual currency. I believe in the next couple years is going to be a lot more. But for us, what do we need to know? I go to work and I work for doing something, contract labor. I earn $20,000. The guy pays me in Bitcoins or any other kind of virtual currency. Okay? So at that point, I've now earned $20,000. I got $20,000 of earnings. Then when I sell the Bitcoin, I might sell the Bitcoin for $18,000 or $24,000. If I sell it for $18,000, I have a capital loss of $2,000. If I sold it for $24,000, I would have a capital gain of $4,000. If I kept it short term. If I kept it long term. Okay, and so you need the dates when you get the Bitcoin, when you sell the Bitcoin. Pretty much that's okay. That's all that I wanted. When I went through chapter 1, I didn't quite get everything. So let's go to chapter 2 now. believe it or not, guys, after I finish this, I go back and read this myself and go, oh, did I miss anything? And then I check and make sure what I'm trying to do is make sure I get all the things that you're going to learn for the test. You're going to at least, I've mentioned them. And as we go through more and more, I'm going to go, by the way, this is going to be on the test. This is not going to be in theory. Okay, so couple things, let's go through. They usually hit constructive receipt. When do you receive it? You get a check in the mail on December 24th. You go, hey, I'm not going to put this until next year. I put it in the bank next year. You constructively received it that year. Okay? You get somebody brings a check, but they drop it off at your business, and you go, I'm not going to go back to work. I've only got 3 days left in the year. You've constructively received that money. They're probably going to have constructive receipt, right of climb, compensation for services, things like that they're going to have. So, right of claim. My insurance company gives me $4,000 for some reason. Okay? They give it to me for this year. It's income to me. Okay? Then, next year, before I do my taxes in January, they go give me the money back. Even though they do that, and by the time I file the tax return, I've already given them the money back. I had a right to that money during 2018, so I have to count that as income. The next year, I get to take it back. Okay? That's called right of claim. Go ahead. Okay. We'll just say 4,000. A company gives me $4,000 for work that I've done for them. And they'd already been paying me all along. And they thought that they owed me $4,000 more. They gave it to me right now. Okay? Then, here's the end of the year. We get into January, and or February, and they count up they do all their bookkeeping. They go, oh, we gave you $4,000 too much. So you have to give us the $4,000 back. So I give them the $4,000 back. I do my tax return here. I can't just net those off. During the year 2018, I had that money, so it's income. And this year I take it back.
How do you take it back? How do you report that?
You'd probably take it back as a probably, huh?
No, I meant, how does the person that you give it back?
It depends on how you got it. Let's just say it's a business. It would be taking it back as a business income. So your income would be 4,000 less.
No, but you paid something out.
They paid you 4,000. You counted this as tax.
What were we talking about? The business who paid the person?
The business that paid, let's just say they paid another business. I'm a self-employed, sole proprietor. Somebody paid me $4,000. The next year they go, we paid you too much, give me the money back. Yes. Then accrued, you would count it as you got it here, and cash business, you'd count it as you got it here.
What?
Yeah. You accrued it because you thought you got the money. They owed you the money.
And it's the date that they send you the check. So if even they're paying you for 2013, if they mailed it to you and you receive it 2016, you have to declare that in 2016. Now after if they've amended their bookkeeping and they found out that they overpaid you, they can come back.
If you're on a cash basis and they send you the check in this year, you don't have to count it as income because you're on the cash basis. Accrual basis, you would have. They're gonna ask you the difference between cash and accrual basis somewhere along the lines also. Does this make sense? This is right of claim. You had the right to this money during the year 2018, even though you had to give it back. There's different kind of things. Other things, you might take this back as a correction on your Schedule A. But nowadays, I don't know how that's gonna work, because nobody's gonna itemize much anymore. You're not gonna get, it's not gonna be a fair deal.
Right, so what if you're a W-2 worker and they overpaid you on the first year and then took it back the second year?
Then you would have to pay, your W-2 would have this included.
And then the next year W-2 would be 4,000 less.
Probably, I'm not positive on that.
Like, how would you make that up? I mean, how would you
Oh.
show?
No, I really like the DFAS. What happened is, if you remember, they had issues on overpayments.
Yeah.
And then they recourse it the following year. We amended, it depends on how. it
You
was
might have to
written.
amend your payroll,
Right.
your
We'll roll it
941s,
over, yeah. Amend it to the year that they made a mistake.
which means you,
But it all depends, but that's how the FAS is.
but that's what that means.
It wasn't-
You had access to the money, so you have to count it as income, even though you give it back the next year. That's claim, right of claim. Compensation for services. That's pretty easy for it, right? You get money for your services, that's income. Whether they give you dollar bills, cryptocurrency, or they give you a brand new truck in return for working for them for 3 months. It would still be they gave you, the fair market value of that truck is $30,000, then in effect they gave you $30,000 of income. Usually it's the fair market value at the time of receipt is what your earnings are.
Is that on a 1099 from the company as far as a car? Or you have to be honest and, like, if you don't receive any salary, you have to report it?
Yeah. Well, there is the under the table. The IRS doesn't play under the table. For them, there's no such thing as under the table. Everybody here understand what I'm talking about? You get a construction worker, comes in and goes, that guy promised me. And the guy sends him a 1099 because that guy went to his accountant. The accountant says, if you don't send him that, you can get a big old fine. And so he sends that worker, and the worker goes, this was under the table. I don't have to pay tax on this.
I have a client had that too.
Huh?
I have a client that too last year.
That actually, yes.
Yeah.
I called him and then like, oh, the owner said, oh, he's not gonna give me 1099. I said, no, we're the accountant. We don't want to get fined.
Okay.
We give it to 99 if it's 600.
600. And is there a fine for not giving the 1099 in the business? Yes. We'll probably get into that in part 2. But if you don't give 1099s, so you come in and you go, hi, and this guy goes, I'm running my own business, and you start writing all this stuff down. He gives you a sheet of his expenses, and you look at him going, wow, you did all this by yourself? You didn't have any contract labor? And he goes, well, my brother and my cousin and so, and you go, you give him the spiel about if he doesn't turn this in, he will be paying all the taxes, and on top of that, they can get him for helping somebody else evade taxes, and they can make this really crummy fine and penalties.
What if a person exchanges everything in cash, but has like a paper, oh, this is my.
So is it okay for that person to steal?
No.
Okay? So if they do it all in cash and they don't report it, it's still, you know,
Well, it's not, like, but they tell you on, they put it on a paper, oh, this is how much I'm making, my deductions.
uh-huh.
Do you take that, they take it at?
You, I would make them put it on a piece of paper. I make a copy of that piece of paper. Then I go, this is my copy, this is your copy. Let's go over this. And you're saying, I paid blah, blah, blah. And I go, you don't have any receipts. And you give them the little routine going. The IRS requires you to have receipts. They can fine you. And there's penalties for not having receipts. There's penalties for not giving people invoices. People give you so much money during the year all the time. Well, you're supposed to have invoices for all that. You're not supposed to just look at the ceiling and go, I made 10 grand. What's the maximum earned income credit? I think I made 12 grand. I have no expenses. You better run those guys off. No, there's a problem. When you guys become enrolled agents, you're going to be held to a higher standard. Because now you're going to go, you went through all this testing, you just got through proving you know what you're doing. So it's not going to be going, I didn't know I had to ask those questions. This is about 4 years ago now. There were two ladies at one of the big corporation firms. One of them got a $36,000 fine and one got a $24,000 fine for earned income credit for not doing due diligence. They wrote no notes, and they had niece and nephews on all kinds of stuff. Some of them, they were probably really were their niece and nephews, but they wrote no notes, and they go 500, 500, 500 before it went to 520. And we all need to make sure, document. That's going to be, you're going to probably, by the end of all this, you're going to probably do better documentation. Or not. Okay. I made prepaid income. Okay, so prepaid income is generally income, right? So if they paid you in advance, that's generally going to be your income. Bartering, you're trading one thing for another. I'm trading my work for a new computer. I'm trading my new computer for your horse or anything. It's the fair market value. Okay? If I have a basis in my horse of $1,000 and I trade him to you for $2,000 worth of work, okay, you would have to put down $2,000 of income. I would have $1,000 gain on selling my horse, because my horse had a basis of 1,000 and I get traded to him for $2,000 worth of work. I had an actual gain, right? That's another one. Bartering is where it kind of gets lost in the shuffle sometimes. People forget, oops, do I have to count that? We'll get to later on, we'll get to rent. Somebody, instead of paying, they had supposed to pay you $2,000 worth of rent. You do some work on the house, and so instead she only charges you $1,000. Well, she has to count the whole $2,000 as income and subtracts the $1,000 of expense. You have to count that $1,000 she gave you of rent reduction as income. Everybody pretty much with all this. All the things we're talking about now are pretty much questions. Assignment of income. Assignment of income is, let's see, I get $500 worth of dividends. And instead of me taking them, I go, I'm in a high tax bracket. I'm just gonna give them to my son or daughter, and they put them on their tax return. They can't do that. I should claim the dividends on my tax return, and I give them a gift of whatever that is. Something like that. Anything you're giving to somebody, you can't just do that. Alimony. Okay, I made you guys two little sheets. These are two examples that every year they used to always have one of these problems. Okay, it's a recapture of alimony. So, which one do you guys want to do? Let's do the easy one with the round numbers. Okay, so 40,000 is the top number. And what this is 40,000. Oh, no. 60,000, 40,000, 20,000. So, somebody's getting divorced. In a way to hide their divorce to settlement as alimony so that the other person ends up paying taxes maybe in a lower tax bracket, they give 60,000 of alimony the first year, 40,000 and 20,000. If in the first 3 years you do that, and it's usually if it's less than 15, if it's more than a $15,000 difference, you've got to recapture some of that alimony. So here's a sheet. Instead of me putting it on there, I just make copies this year. Used to I go through and work this out with you guys, but So everybody has one of these?
Yes.
Okay, so I copied this, I believe, maybe an IRS worksheet. It's either IRS or NAGP. Anyway, it's always pretty much the same. You take year number 2, and then you subtract from that year number 3 plus 15,000. I learned it a different way. I learned to subtract the 15,000, then subtract year number 3. It doesn't matter.
What's the
15,000 is that there's a limit. If the difference from year to year is more than 15,000, you have to recapture some of the alimony. So the guy, we'll say guy in this case, the guy has been writing these amounts off as alimony. By the way, 2018 is the last year of doing that. Starting now, you cannot write off alimony, and the person getting the alimony doesn't have to count it as income. So everybody, all the lawyers will be renegotiating everything for the new year. Wait a minute, we're already halfway through the new year. Yeah, so 2019, no more alimony. But your test is for 18. You know, they may not even give this as a test. Every year they gave this as one of the questions. Okay, so you take the second year, 40,000, you subtract 20,000 and 15, you have 5,000 left over. So what that meant is you're going to have to recapture $5,000 between the second and third year, okay, as alimony. Then you take the first year. You say you take the difference between alimony paid in the second year. The 15 plus the 25 is 25, plus the third year of 10,000. You add those together, that's 35. Divide by 2, 1,750. Then add the 15,000 that you get every year to deduct. It makes it 32.5. Subtract that from the 60 is 27,500. Right? Oh, I was doing a different problem. Anyway, so the first year should have been 15,000 difference. So you add the 15 to the 27.5, and so now after the third year, he's gonna have to recapture 42,500 of the alimony that he's been writing off. What did he write off? $120,000 in these 3 years. Now he's gonna have to recapture almost, a third of it. He adds that to his other income. I believe she would also get to deduct that possibly. Okay, there's a second one of these. I just made it for you guys just for you to get it. If used to, everybody needed to know this. With the new changes of alimony, I learned it for the test, but you're probably not going to ever use it again unless they change all our tax laws again. Could that happen? Yeah. Probably before, depends on what happens in the presidential election. If the Democrats win, I believe we're going to get all those miscellaneous 2%, minus 2% deductions back. I believe they will come back. If Mr. Trump wins, I believe millionaires will get free taxes and all the rest of us will just give them all our money. Joking. What's that? Okay. I'll try to stay non-political. That's like biting my tongue. It's gonna hurt. Okay. Debt discharge, cancellation of debt. We're not going to go into that. Cancellation of debt is taxable. There's some exceptions. If you're bankruptcy, you go through a bankruptcy, or you're insolvent. What do they mean insolvent? Okay. I owe 30 grand to my credit cards. So I get a 1099-C in the mail. And I go, oh, yuck, what is this? And then they come in to show you guys this, and you go, what is this for? And you go, oh, well, I got out of my credit card debt. Ooh, you got to add this to your income. So, here's what you might be able to do. If you're insolvent, what does insolvent mean? You owe more debts than you have income. Okay? If you're living on $2,000 a month and your rent is $1,500, your food is $400, and your other stuff is more than you're making less money than you need to live, and you have no assets. If you have a 401k, you have assets. If you have an IRA, you have assets. A pension, you don't, because you don't have access to that. So, but a 401k or an IRA, you have an asset. So, let's just say you have $3,000 in your IRA. So you're solvent up to $3,000. So out of this $30,000, you for sure have to be able to pay $3,000. If you had a brand new Mercedes worth $50,000 and your dad gave it to you, well, then you're not insolvent. And you'd have to pay tax on that. If the fair market value of that brand new car is worth more than the $30,000. That's not really the case. Mostly when you're getting bankruptcy on credit cards, you're not doing that well. I had a girl, this is 10 or 15 years ago. Real cute girl, little blonde girl from somewhere on the mainland. She married a programmer. She was in debt, worked for, what was that thing? Hard Rock Cafe. She worked there, barely getting by. She was in debt completely, bankrupt. After she went and got the 1099 miscellaneous, she married the rich guy. They had, let's say, $250,000. But she got to write off because when she got that, she was insolvent. So she actually got to claim insolvent and didn't have to pay her credit cards debt, even though she was married to a rich guy, because when she got and had the debt, she was not married. I thought that was wrong, but it's not my job. I don't know if they're gonna ask this, but if you do get to write off this off because you're insolvent or bankrupt, you have something called attributes. So if you had an NOL that you were carrying over, you'd have to reduce it by the amount of insolvency. If you had something like business credits, you'd have to. If you had property, and the property was even upside down, you owed more than it was worth, so you didn't really, you were still insolvent. But the property was worth 300 grand. You owed 320, okay? But your $30,000 over here, you would take that 30,000 and reduce your basis to 270. I don't think this is a little too advanced to be in this test, but that's what called attributes are. You could take your people that have a bunch of land usually don't get to go say that I'm insolvent. But if it, back in 2000, I don't know if you remember 2008, 9, 10, there was a bunch of people that owned a bunch of land. They had a house, they had buildings, they had all kinds of stuff. They bought them in 2007 and 8, and now they were worth less than what they paid for them, and they might have owed more than they were worth for a few years. Those were the kind of people that lost their job. They were going bankrupt, and they got to use all this stuff. Now we've been doing good for a while. Okay. Social Security, when I started doing this 30 years ago, we had to do Social Security by hand. I'm not going to go through and do Social Security by hand. But does everybody know the basics? For single people, 25,000, married, 32, and what is it, 34 and 44? Okay, so if half of your Social Security plus your income for a single person is under 25, none of your Social Security is taxable. If it's over, it's either half of that number or half of your Social Security, whichever is the less. If you're married, half of your Social Security plus your income. If it's under 32, your Social Security is not taxable. I haven't done this in real life in years. Every now and then I go look on the computer just to see it, because I have a worksheet that prints out on my software for it, and I go look at it just for old time's sake. In the early 90s, we did it by hand. Scholarships. So you got to know that there's taxable scholarships. This gets missed a lot. So you have somebody that has a scholarship, they get to write off their scholarship for their books, their tuition, their books, their fees. But if they have a Pell Grant and they get $6,000 for their Pell Grant and they don't use it for their tuition, they got the money, but it's all taxable. Okay? Other kind of scholarships. If you use your scholarship for room and board, that's taxable. So I get a $20,000 scholarship, and my tuition is $15,000, and my room and board is $5,000. Boom. Really, I'm supposed to have a $5,000 of taxable income. I don't know how all the athletes get out of it. I played football in college, and I never even considered that. Nobody told us about it. In Texas, though, they don't care. You don't even have to go to class if you can block real well. That was 50 years ago. Or more than 50 years. Okay, but understand, so what am I saying? Room and board, if you use your tuition for anything other than what you're supposed to, if you use your scholarship for anything other than tuition, books, and fees, it should be taxable income, okay? I've met hardly anybody that catches that, myself included probably a few times. Okay, here's another trick. You've got a kid that comes in here, they make $6,000 in tuition, and they got $6,000 in scholarship. We'll just say Pell Grant. And you know their parents, and you go, if they count this scholarship versus this, they basically have, it breaks off 0, okay?
What was the top number?
6,000. This is their tuition. This is their scholarship. They break off even. So they're dependent of their parents. Their parents can't take the education credit because the scholarship in both of these are equal, right? This is a really good trick for tax preparers. You make $4,000 of their scholarship taxable. So now on line 7, they would have $4,000 for the kids. The kids are still dependent of their parents, okay? But with $4,000, you get, even if you're someone's dependent, you get $12,000 standard deduction. They pay 0 tax. They might pay a couple dollars to the state. They would, okay? But their parents would now get $2,500 education credit, American Opportunities Credit. I presented this once at a conference 4 or 5 years ago. I had everybody answer, wow. You know who told me about this? The IRS. The IRS, and now it's in your Pub 17s. Look under education credit, it'll be there. What is that? That's $2,500 for doing nothing. You just made friends for life with somebody's parents. Okay. Do we need to take any bathroom breaks or anything? Yes. Unemployment, always pretty much taxable. Compensation for injury and sickness. I could go over this and spend time, but I'm going to just let you guys read this. There may be something, okay. TDI NOI generally is paid by your company. If the TDI is paid by the company, then your TDI is taxable. In other states, TDI is sometimes paid by your company, sometimes paid by you, or let's just say it's half and half. Then half of your benefits would be non-taxable because you paid half of your TDI. You see how that works? And that, or if you paid all your TDI, all your benefits, it might be up to the amount of TDI you paid.
So how does your employer TDI?
Because they have to. It's a state law.
No, how is it?
You have a form that your company gives you. Sometimes companies can take a small portion of the TDI premium and have the employee, and then they put it on your W-2, probably where city tax would be down there, where the state taxes are. And in California, they call STDI, state, SDI maybe, state disability income. And other states do that. They have different, sometimes they make, you get to write that off as like state taxes. Treasure trove. Okay, treasure trove. In this case, they use a piano. I buy a house, and in the house, I want to do some remodeling, and I go into a wall, and I found hundreds of dollars of bills stuck in the wall. 100 grand. That's taxable income, treasure trove. If I find something like that. In this case, they say they found, what, $10,000 in a piano? The same kind of premise. If you get lucky and find something, the IRS says, yeah, right. What I actually reported, I'm not so sure. If I found it in my wall, of course, if Guido, the drug dealer, came back knocking at my door, I'm going, or Pedro, or whatever. Okay, they did not have done this. Employer provided life insurance. If they can pay, your company can pay for up to $50,000 of life insurance, no charge. If they give you more than that, they have to count the cost of the premium as part of your income. Rental value of parsonage, if you're a minister, usually your house, as long as the board of directors for the church has put it in their minutes saying we'll give you up to so much a month, $2,000 a month towards your house, that is non-taxable income to you, except that you have to count it as Social Security, taxable for Social Security. So does everybody get that? They give me $2,500 a month for me being a minister on my W-2. They also give me $2,000 towards housing allowance. It doesn't matter if I'm renting, buying, whatever. They give me $2,000. That's not taxable income, but it is taxable for Social Security purposes, so you'd add it to Social Security. It would also count for earned income credit. You're probably not going to get that. But the part where it's not taxable. So, what happens if they gave you $24,000? You don't have to pay tax on it, and you use it for a mortgage on your home. Well, you still get to write the mortgage off. You still get to write the property tax off. You don't have to pay tax on that money, but you get a good tax benefit.
Could you give me the amount of the income as Social Security for married?
Huh?
Like,
Okay, 25,000 for single, 32,000 for married. If it goes over that, you pay 50%, up to 50%. Okay, but if it goes over 34,000 for single and 44,000 for married, then you pay 85%. Got it? Combat zone compensation. If you're in the military and you go over and fight in Afghanistan or some other dangerous spot, you can, your compensation up to the highest enlisted man for officers, and whatever your compensation is for people that aren't officers, is going to be tax-free. What does that mean? If I'm a captain, I can only get to write off as much as the highest sergeant. It's not an officer. So, and then I have to pay tax on the rest, because they don't want it to benefit officers too much. And so when is it? If you're serving in a combat zone, or if you're hospitalized because you got shot in a combat zone, or something happened to you. Reimbursement of moving expenses, that's all going to change. Moving expenses are no longer tax deductible except for the military. Adoption expenses. So you get a little over $13,800 something for adoption expenses. So if I had to pay $13,000 to adopt a baby, I get to write that off as an adoption credit. On the other hand, I've been able, my company, if they have a plan, I'm not sure there's rules and they got of their plan, you can have another $13,810 written off. So if I had let's just say $30,000 in adoption expenses, and I got reimbursed by my company for $13,800, the company would not count that as my income. Then I could actually have can't use the same expenses, but I get another $13,810 for an adoption credit. Everybody good with that? But I had to have spent the money. There's a special rule if you've got special needs child. You don't have to spend the money. If I get the adoption credit for a special needs child, and what are the rules for a special needs child? That's a good question. Okay, they first, they got to be special needs. And what does that mean? There's a set way of saying that and doing it. I've got to see where it is. They got to be put in your care by a government agency has to certify this. I can't see it right now. Special needs are different. I don't see it. Okay. Other kind of income, working condition fringe benefits. So these are things, what would that be? I work in an office and they let me use their computer to write personal letters on occasion, other things like that. They let me use they let me use our tax program to do their taxes for free. Those are just fringe benefits. They don't cost the company anything, and we don't have to count them as income. Your employees don't count them as income. De minimis fringe benefits, those are things that are small, little bitty. Due to the low cost, occasional use of company copy machine, personal letters, tickets to the entertainment events, occasional taxi fare, coffee and donuts. Oh, no, coffee and donuts. Okay. Employee discounts up to 20% of the price offered to customers can be an employee discount. You don't have to count that as income. Transportation fringe benefits. Qualified transportation fringe benefits up to $260 per month. Okay, so what would that be? You get a bus pass or parking or something like that. They give you free parking. You don't have to count that as income. Huh? $260 a month. That's pretty good. If you get cash in any of this stuff instead of the benefits, that's income. Employment provided educational assistance, $5,250. You get to write off. What about if you're paying for your own education anymore? I believe that went away with the 2% deductions. Do you understand what I'm talking about? Used to, if I was paying for my education and it was part of the job that I was doing as an employee, I could write off. Huh? Yep. But now there is no more 2%.
Can't you use a lifetime learning credit for that instead?
If it fits the lifetime learning credit. Oh yeah, you probably can. Up to 20%, but that's not the same. It depends on the circumstances whether it will work out for people. foreign earned income exchange this year, I think you need to know the number, 103,900. Every now, that's one of those that you just gotta know. So what does that mean? I have earned income. I go away to a foreign country. How long, I've got to be there, let's say I have to be there for over 330 days. Okay? What's that? 330 days? 330, yeah. And what happens? So while I'm there, let's just say I stay for exactly a year. And in that year, I earn $120,000. Well, then I would get to be able to exclude $103,900
From that income.
from that income.
In the foreign country.
What happens if I only earn 90? I get to exclude the whole thing. But besides that 90, I earned interest income of $1,000. I had a pension of another $30,000. And wrong answer.
From the foreign?
You don't get to subtract. That's not earned income. So that 10,000 would still be taxable. It's not earned income. It's not passive income. Has everybody got that part? It has to be earned income. Foreign housing allowance, read it, 31,171. I can't really, not much to tell you, that you only get a portion of it generally. Community property income, I'm just gonna also the same thing, I'm gonna let you read that. What is community property? In certain states, community property, say California being one of them, that's what yours is mine. And if you have income, you have to consider sharing. So if you file separate tax return, some of your spouse's income is considered your income. Read it because it changes. And in Texas, even if you, before you get married, you have $1 million in the bank, and you married some nice person, they don't have anything, but in Texas, all of your income becomes joint income. You would still own the $1 million, but the income from that $1 million would be half your spouse's. So if your daddy left you $1 million in cash, you might want to go talk to a lawyer before you marry that person.
Wait, can you repeat that? So, if you're the poor person and then you marry the rich person, then
And file separate tax returns, you might split the income.
you have to file the half of his income on your tax return?
That could happen.
So does she have to pay taxes on that income?
And, oh wait, that's her income too, though. Let's just say it's $60,000 of interest. 30,000 of it belongs to you. So you pay the taxes out of your 30,000. There could probably be some divorces over stuff like that real quick. Or somebody would start reading tax law real. But do you understand? There's more to it than that.
It's money, but it's
Statutory employees, really we're talking about full-time life insurance salesmen mostly. What is that? On the W-2, there's a box that says statutory employee. If it is, that employee gets a W-2 and they take out his Social Security and Medicare, they don't take out withholding, and he puts his income on a Schedule C and gets to write off all of his expenses against it. But then, he doesn't have to pay self-employment tax because they've already taken the taxes out.
we get all that. Don't go on.
Okay, think of a W-2. And we got $100,000. And out of that $100,000, what did they have? $6,200 and 145, something like that. Zero withholding, but then they would have this 100 would be here. Box 1 would be 100. Box 2, box 3 would be 100. Box 5 would be 100. They'd take out the money for the Social Security and Medicare. Okay, but they wouldn't take out any taxes. But instead, you get to transfer this, and your computer will do it automatically to a Schedule C, and you get to deduct all of your expenses. So if he had $30,000 worth of business expenses, he would only pay tax on $70,000, although he would have had Social Security taken out of the whole $100,000. Has everybody seen? Have you ever all seen somebody that's a statutory employee? How many people here do taxes regularly? You're new to all this.
Lonely.
Tax season only.
Yeah.
Well, that's what everybody does.
Okay, so what type of person would be a statutory employee?
Insurance sales.
Insurance salesman is most. It also sells salesmen that sell everything but milk. I'd probably be beer salesman, you know, that go around selling stuff. They're running their own business. So, and I don't know why milk doesn't count in there. But that's all. If there's 4 answers and one of them is milk, that's the one.
That's the one.
Okay, so interest income. Interest is reported under the doctrine of construction receipt. So you earn $100 interest in your bank. You don't take it out. You still earned it. It goes on your tax return. You're going to get a 1099 INT from the bank or somebody. Same thing with dividends. You earn dividends and you earn capital gains from your mutual fund. They'll come on a 1099 DIV, and you will have to fill out. And there, sometimes there'll be a bunch of other little boxes that are a nuisance. And hopefully your computer does it right. Imputed interest, you'll have this somewhere. I'm not sure, Ben. Part 1. Imputed interest. If I loan somebody money and don't charge them interest because they're a friend, a business associate or something, it's called imputed interest. I have to count as income the interest I didn't charge them. Yes. So let's say that the minimum interest the government has right now is 3%. I loan them $100,000. I have to charge them 3% a year, and I need to put that on my tax return, even though I didn't actually collect it. No, I could have been, but it's income. Then I could give it as a gift, but I still have to count it as income. Remember, I can't transfer the money to them. I got to count it as income, and then I can give them a gift. Yeah.
Is there a threshold on personal or not? Because that on business is a threshold you have to start counting.
Yeah, there's a minimum amount. Maybe it's under 10 grand, and especially with your kids. If let's say you own part of a corporation, and the corporation gives you a loan like that, the corporation would have that income, and they gave you that. It would actually be a dividend to you, or something. Probably a dividend. Savings bond, there's some rules for double E and I savings bonds. You can use those for tuition. There's income limits. Okay, interest on state and government obligations. Usually, so what happens if I have a city bond from Honolulu? I may not have to pay federal income tax on that. Just like on a savings bond is not taxable to the state. Aside, that's not part of the class, I have a municipal interest, but it's not in Hawaii, it's in California. Then Hawaii says that is taxable.
Unless it's the same.
They don't let you write off California bonds in Hawaii, and I don't think California lets you write off Hawaii bonds if you're a California resident. What happens if you got a bank account with you and your mom and your sister, and you get $1,000 interest, but it's divided up equally? What you would do is you have to put the whole amount on there, and you would call, forgot the word. I think it starts with a T. You'd put the whole amount of interest on there, then you'd subtract the part that goes to your mom and sister. Okay? So you would only pay tax on your portion. But then you have to send your mom and sister a 1099 INT for their portion of the interest, so that the IRS makes sure that they pay their tax on their interest. Everybody understand that? That's been on the test several times.
You're required to issue a 1099 INT to whoever is sharing with you.
Yeah.
Oh, wow. So, but then, the reporting time, let's say we normally receive it by the end of the year, by January. So.
Well, you're
and
supposed to
the
give it to, yes.
So she would get penalized if she doesn't send it out by January 31st?
Can we
I
just tell them
can't
to
say
claim?
for sure on that.
Can we just not divide it like what we normally, if they're.
Just
very
put it on, leave it on
separate?
your tax return?
Yeah.
Yeah, probably could do
Because
that.
instead of generating a 1099, it's so hard to get a 1099. You pay $150 for just to issue a 50.
Oh,
Yeah, the
you get them for
1099.
free, you just go to IRS
That-
1-800
yeah.
form, 829 form,
True.
and you get it, call, oh,
No,
want to send me
it's
some
not really
1099s?
True.
I think you can do it also, go to irs.gov and get them mailed to you that way.
Is that also for the, when people have one mortgage and there are three of them?
No.
No, okay.
You can just list down the names and the social security numbers, right, on the Schedule A. That's
For when mortgage
only for
interest.
mortgage interest.
Mortgage interest, if you have a person holding the mortgage interest, instead of like a bank or a mortgage company, you'd put their name, their social security number, and their address. And there's a spot for, that's mortgage interest. That would be like on a Schedule A.
But for regular interest. on
This
the
is interest
1099
you earn. You got interest from a bank of $1,000, we'll say. And a third of it goes to you, a third of it goes to your mom, and a third to your sister. So unless you want to claim the whole 1,000,
Right.
you have to,
Whoever
I
has
can't
the
think of the
social
word.
security, whoever has, the top social
Huh?
security can claim.
what's that now?
Let's say if I have 3 sisters in the account, like mine is on top. For reporting purposes, so my social security is on top.
You're on top, and so they
Right.
give the
I
1099 to you
know.
for the whole
So as
amount.
long as, it's then I don't have to reissue a 1099, right?
Yes, as long as you wanna claim the whole thing.
As long as it's not a million, then it wouldn't be an issue. If it's only like a small amount. Yeah.
Okay.
And that goes for dividends too? Everything? For interest and dividends?
I don't know about that. I've never come across that. I believe the guy that gets the 1099 gets the dividends. Because who owns the stock? If you own the stock, you would get it. And by that rule we were talking about, you can't just give it away to other relatives. Same thing, this wouldn't apply if you put the whole amount of money in there that earned that $1,000, then you can't do that. The person that put the money in, this is if each of you, your mother and your sister, put a third of the money in. That's when this would apply. This doesn't apply if the dad wants to give the money to his kids. Can't do that. You have to be the one putting the money in. I can't find that. There's a word that I'm looking for.
Let's Google. Interest.
Okay. I'll think of it. 10 o'clock tonight, I'll wake up and,
I know, yeah. We hate those.
Okay, dividends reinvested. You pay tax on the dividends that get reinvested. I have $1,000 of some kind of stock. They give me a $70 dividend. I reinvest that dividend. They will send me a form and I will pay tax on that $70. Now my basis in the stock is $1,070. Everybody see how that works? So if I sold it the next year and I sold it for $1,090, I would only have a $20 gain.
Why is it basis plus 20?
Okay, watch.
Because you already.
I spent $1,000 to buy 100 shares. Sorry about my writing. Then at the end of the year, I got a $70 dividend. I reinvested it in stock. So now I own 107 shares, we'll say. I think that's, maybe that would be right. Yeah, 107 shares. If the shares were still exactly the same price they were a year ago. So now I sell these 107 shares for $1,100. Instead of having a $100 gain, I'd only have a $30 gain because I've already paid tax on this $70. And so I don't, it increased my basis in my stock. They're gonna give you this, and another one, we're not gonna worry about it now, we'll get it later. You buy 100 shares of stock for $10, $1,000. Next year, they give you a stock dividend, 10% on your shares. So they give you a $10 stock dividend. But, let's just say $10. So now you have 110, and it's still, so it's worth 1,100. I'm sorry. You didn't pay for that, it was a stock dividend. So you have 110 shares and they're worth 1,000, so they're worth less money per share. Okay? If you sold 55 shares, you'd be selling, their cost basically would be $500. If you sold them for $20, $1,000, you would have a gain of $500. No, wait, $20 a share times 55 would be $1,100. Do you understand what I'm getting at? So 500, so you would end up with a $600 gain. We're not going over this right now, and when we do go over it, you'll get to read about it first.
Are we gonna do some questions together?
What do you mean? Royalties and rental income. Okay. Royalties are just royalties from, usually from things like, you have oil royalties, you have royalties from selling timber on your property, or royalties from a music song that you sold. You're a famous musician. This was years ago. I had a friend that was Keith Richards' friend. 10 years ago, he was worth $250 million. They had a joke, you know, with the devil and Keith Richards playing guitars together. Keith won. The devil, okay, you win. It was in the newspaper a couple days ago. It was that people joked there at one time, 20 years ago, people were betting on how long he would live. And he's outlived, he's like 75 now. Outlived them all. Okay, that's not important. Okay, so, but if you're a musician, you get royalties. You write a book, you get royalties. Those are taxable. Okay, ordinary income. You have rental income. Your income is rental income. There's a bunch of rules for that. We're going to go over that later, but right now, basically, Schedule E is not used to report income and expenses from the rental of personal property. Where would that be? Schedule C. If you're renting your personal, let's say, some guys do this that are in the movie business right now. They rent some of their personal things to the, like when they're shooting Magnum PI or something, or Hawaii 5-0, they might rent their car and they just park it somewhere on there as just a prop. Or they might rent, they have a bunch of stuff that they keep and they rent. That's personal property rental. That's a Schedule C business. That's not a rental. Okay, personal property rental. But when we have a rental, you're renting a house. That's rental property. That goes on Schedule E. Rental income, if you receive the income during the year, even if it's for income after the year. So somebody in December pays you rent for December and January, you count the whole thing as income. But on the other hand, if they pay, so they pay you the first and last month's rent in December, that's all income. But different than that, they say, I'll pay you the January rent and I'll give you a deposit. A deposit is not income. Different than first and last month's rent. Okay. These are the ones I'm hitting are highlights that I think they're going to give you questions about. And it's going to be only 1 out of 5 of you maybe even get that question. Some of these more than that. Prepaid rent is included in gross income. Okay, so, rental income from a residence is including gross income is less the residence is renting for less than 15 days a year. That's what they call the master's rent. Okay, the people that where they play the Masters golf tournament, they rent their houses out for 14 days every year while the Masters is going on. They rent it for like a fortune. They maybe could rent the place for $2,000 a month if they're lucky. Well, they rent it for $10,000 a week because it's right somewhere close to the Masters. That's whatever. Okay, so if you rent your house for less than 15 days in the whole year, you don't have to declare that income. That is a windfall profit for those guys. And that would probably apply to other places too. Okay, but if you go one day over the 14 days, on the 15 days, then it's all, you have to declare all of it as income. And you only be able to take the expenses in relation to the rental part to the personal part. So you add up both of them together. And so you rented it for 30 days and you lived in it for 90. So that would be 120. So 1/4 would be rental and 3/4 would be personal. So for your mortgage, interest, and property tax, 3/4 for your Schedule A and 1/4 on your Schedule E. But other things that you're writing off, utility bills, 1/4 for the rental, but you don't get anything on your personal A, and all the other expenses is all on the there's some other rules that go with it. Let me see if I can hit them real quick. If you rent it out for less than fair market value, that counts as personal. You rent it out or give it to your relatives and they don't pay your rent, that's considered one of your personal days. Okay? You rent it or you trade it. You stay in this person's house in New York City, they stay in your house in Hawaii for a week, and you pay them rent and they pay you rent, it's still considered personal. Okay? So you, and if that happens, then if you go over that 14 days, then you got to count their money as income. And if you live in the house more than 14 days, then it has to go in the proportional side, which means that you count up the days you're there, the days that it's rented, take that and you get a proportion, and then you take off all this. Probably when you read this stuff now, so does everybody know that next week we're going to take off a week and let you guys read the first 3 chapters and make sure you got it, because you haven't had the books yet. A few of you have, but most people don't.
So no class next week?
No class next week. You're going to read the first 3 chapters. The following week we're going to go into the next 2 chapters. We're going to probably only get through, we're going through business expenses next, right now. Okay, we spent more time in the other one than we did in business expenses. Hopefully, has everybody here done business tax returns? You haven't done tax returns? You just do your own?
That's a business.
So just one business?
One business? You do tax returns during season? You do tax returns?
Like
11/20s. Corporate tax returns? Well, you'll be good in part 2. I know you do a lot. Okay. So half. The people that don't, if you don't get it, I would rather help you now. It's easier before you get too far along. Except that you better do it the next couple of days, because Friday I leave for Yellowstone. I'm going to go play with the bears. Hopefully they don't play back. Okay, so let's go ahead and get business expenses. If we don't get quite through, we'll finish it in 2 weeks. And we'll do the next 2 chapters. What are the next 2 chapters, you might ask? I'm glad you're asking. So 4 is above the line deductions and losses. Some of that's getting knocked down a lot. It's actually only 8 pages. Then itemized deductions and qualified business expense. Oh, no. Itemized deductions will be good. So we'll spend most of our time on chapter 5, but if we miss any of chapter 3, chapter 4 is short. Chapter 3 is kind of short. But by the time you get through the last qualified business income deduction, your head will be spinning. If I can actually teach it. It's been a moving target for us in the tax world since it started last year. But I've got some more, I'm going to read about it, and I've got other books that I'm going to read, so I'm going to get you the basics. I may not get all the nuances. It's, by the way, they're giving 8-hour classes on that one.
Where?
Huh? All over the nation. EAs, NATP, CPA, everybody is. I've had a friend that came back from the national convention for NATP, and he brought me, there's a whole pile of books in the other room, and at least a couple of them are just about that alone.
Are you going this one? Are you going?
In September, to Vegas. Are you going?
I haven't registered. I was debating whether to take it here or I'm like,
Okay.
that's struggling.
We're gonna have it here in November, the NATP locally. There's gonna be about 2 or 3 days of classes, because there's gonna be some pretty good stuff.
Are those gonna be just as good as the ones on the mainland?
Yes.
Oh, yeah.
So we have to be members.
No. You don't have to be a member to attend. You get a little bit discount. All of you got that special $85, $95 deal. That was a good deal. You didn't know about that. Okay. They gave us, everybody that signed up, they gave everybody a cheaper, we didn't have to pay a new $25 fee. We can still get that for you if anybody wants to be a member. Okay, so business expenses. There's always the ordinary and necessary. Remember, the old unreimbursed business expenses for employees are no longer. They're not going to come back until 2025, and they may or may not come back then. Who knows? But right now, always before on Schedule A, you could write off things like union dues, tools, your travel, use of your vehicle, meals and entertainment, use of your cell phone, use of the internet, other kind of things like that. Not so much anymore. Everybody, like the stewardess and the airline pilots, are getting killed. The people that are in construction are getting clobbered. And they're not happy about it.
I have a question. Why did they take away the entertainment for business? I don't understand
I don't know.
that
Nobody
one.
ever asked me.
I didn't get that one.
Why take away entertainment? So that people abuse, yeah, people abuse it. Well, so you should get to go have your yacht and go take people for entertainment, big parties, spend hundreds of thousands of dollars and write it off, save money on your taxes.
Well, doesn't it say here in the publications too, like it can't be like luxurious or excessive, like there's.
What's luxurious to somebody that works for a living and somebody that owns a corporation are two different things.
I just thought golf is out the door now, and there's a lot of business that's done on the golf course. So I couldn't understand.
It can still be done on the golf course, they just don't get a tax break.
Yeah.
So, you believe we should pay for some rich guys to go play in their country club golf course? Although my brother was a professional golfer, he used to run golf courses. country clubs.
It's gonna be recorded, right? We can send it to him?
Yeah. And that's what he did for most of his life. He didn't make hardly any money being a professional golfer. He made all of it. He managed golf courses and country clubs for 40 years. Now he's 70. Oh, thank you. So, what a trade or business regularly and continuous activity. You got to be in it to make a profit, so they don't let you have a hobby. So if you're what do they say is a hobby? The rule of thumb: 3 out of 5 years you need to make a profit. That is not always the same. You have to be trying to make a profit. So if you were started a construction business in 2007 and 2009, right when you were starting to make a profit, the whole construction industry fell apart because all the mortgages all went belly up. I don't care what you had done, you wouldn't have made money. But you could have been really trying. And so facts and circumstances mean you can still prove that you're a legitimate business. There's a bunch of other rules that you change your methods trying to make a profit because you didn't do it this way. So it's not just cut and dry 3 out of 5 years. But if you're running a business, let's say you're a fisherman, you just happen to be a doctor or a lawyer and you went out and bought a big fishing boat and you go fishing on the weekend and you say, I'm a fisherman, I'm trying to make money, and you lose money every year because you've got a $500,000 boat you're depreciating. No, they're not going to let that fly. That's an example of that's been done a lot of times. Or the same thing applies that you have any kind of business where you do something on the side and it's not your real income. You need to either start making some money at it or go find something else to do. Question? Okay. So, other than ordinary and necessary, all your expenses, they can't be extravagant, as one of the guys said earlier. Although what's extravagant to one person is not to the next. Rent, advance rent. If you're the guy getting the money, if you get advance rent, that's income to you. On the other hand, if you're paying the rent, it may not be a rental expense until it's matched with the period of the rent. So if you paid for 2 years of rent at one time, no, you couldn't do that. You'd get the year of the rent and the year that it belongs, and the next year and the next year. As an expense, yes. It would be prepaid rent, even if you're a cash basis taxpayer. Travel. If you're doing the travel for business reasons, fine. But if you're doing the travel for a primary personal reason, it's not you can't have any expense. So I just by coincidence am taking my kids to Disneyland, and I'm claiming for my portion it's a business expense, and probably not going to fly very well. But let's say that I go to someplace, Vegas, and I go there for 2 days and go to a seminar all day and go to a nightclub at night. That's no problem. Okay, and the seminar is for 4 days. I'm there for 5 days or even 6. I get there the day before because I want to be rested up, and I leave the day after because it doesn't, the banquet doesn't finish till 10 o'clock at night. That's no problem. On the other hand, if I stay for an extra week and go visit my relatives, that would be a problem. These are kind of pretty simple stuff, right? Usually you can't take your spouse unless your spouse is an employee or there's a legitimate business reason to take your spouse on travel. What do you need to write up? You need to have the time spent for each place, the degree of business activity, the relative income, earned at each place of business? What happens if you're traveling around and I'm in a business where I live wherever I work? I work 3 months over here doing this, doing construction. Then I move over to here for 3 months, move over here for 3 months, move over there. Normally, if I'm living in one spot and I travel here for 3 months, come back, travel here for 3 months, come back, well, all the time that I'm over there, assuming that I have a place here still, that would be travel expense. I'd write off the rent, I'd write off the driving, I'd write off my meals and other things. But if I'm an itinerant, that means I'm just a person moving around and I don't have a home that I go back to, then I can't write any of that off. Foreign travel. Generally, you can't, travel is not part of education. You can't say, I teach Italian, so this summer I'm going to go to Italy and travel around, and that's an education for me. And that's a vacation.
Unless he takes courses in the country.
Oh, well, you're teaching courses, that's a different story altogether. Then now,
Or taking courses, like to refresh your language. No?
it would be facts and circumstances. You couldn't take a 1 hour a day course and probably get away with it. If you were in class all day, maybe. Foreign travel, if it's no more than a week, it is not in a personal vacation, is not a major consideration, and it's less than, the trip is less than 25% of the total time away from home, no problem. You can't go take foreign vacations and just go have fun. But if you take one that's a week, that's not really, that's a good, and there's a good business reason, you're okay. Conventions, usually no problem. Okay, if you go to a convention for investments, how to be a Bitcoin person, cyber, what do you call that? Currency?
Cryptocurrency?
Yeah, cryptocurrency investor. That is not a business. Investments, for you to go for learning how to be an investor, that's not a business. You can't write that off. You cannot. So, I go to a tax account, or any of us go to a tax convention. You can write all that off. But if I went over there and I'm in the business of doing taxes, and I went over there to how to learn to invest. I wanted to be a day trader. I couldn't write that off. That's not a business, that's to me to be an investor. Cruise ships, you're limited to $2,000, I believe, and there's got to be a legitimate business reason. There's got to be, I believe, from the people doing the trip, they've got to be able to put out some kind of letter or something that you put with the tax return explaining that this is a legitimate business trip.
Business would be like the entertainers that have to entertain on the ship.
No. I want to go to be a tax preparer. They have a convention on a cruise ship. They just don't let you go on a cruise ship to Alaska unless you're going to be spending how many hours a day actually learning about taxes. No. don't go playing with the polar bears.
Brown bear.
Yeah. Okay, everybody, all of us that have been around a long time have seen this chart in every Pub 17 that there ever was. These are the rules about transportation. So, if you are going for work in another town and you drive your car to another town for a business meeting, no problem. Okay? And if you have to stay overnight, you can have a hotel room and you can have your food while you're there, no problem. On the other hand, if you're in town, there are special rules about writing off for use of your vehicle. The general rule, if you, I don't know, do all you guys have this available? Enough? Okay. From your home to your work, you can't write off, never. From your work to other workplaces, you can always write off. From your workplace back to home, normally you can't. But if you're going to a temporary work location, if it's not a regular main job, but a temporary work location, you can write it off. Okay, has everybody seen this before and got it? Generally speaking, commuting cost, commuting is never a deductible business expense. Coming from your home to your work. Where's the exception? If your home is where you work, you have an office at home and you have no other office. Okay? So your home is your office. So when you go to your home to different workplaces, you can write that off. Everybody understand how that works? So, one of the tricks of the trade is that you start talking to people and they're in construction or whatever, and you go, do you have an office in your home? And you go, not really. Where is your office? I don't have an office. I do it on my kitchen table. No. You go, come on now, let's go for next year. This year's too late. Next year, you go buy a table. You put it in some part of one of the rooms. You go buy a filing cabinet and you put your computer on that table and you keep nothing there but your business stuff. You now have an office in your room. It may not be more than 10 by 5, you know. It might be something 5 by 5, 25 square feet. It doesn't matter. Now you got it, your office is your home, and you get to take those miles. If you're an employee, you don't get to do that anymore. You don't get to take any miles from me. Okay, that's. So, if the taxpayer's residence is a taxpayer's principal place of business when the meaning of the home office, the taxpayer may deduct commuting expenses. Boy, that's a big deal, guys. Especially when you're not an employee and you got to pay all that self-employment tax, and you get killed every year because you don't take any taxes out. You need all the help you can get. The following, okay, I'm on page 90 if it matters. The following factors are used to determine a taxpayer's tax home. And the general rule is 2 out of 3. If you need 2 out of 3,